Hey everyone, it's Mike from Day Trade Guide with More Than Money Trading and Investing Group. Today we'll be going over the basics of day trading, our strategy and how to apply it, as well as what we provide for our traders in our paid group. We created a quick PowerPoint and demonstration to get all of our new traders up to date with our strategies, as well as teaching them a crash course on day trading. Currently, we're in the middle of creating an in-depth course that will give everything you need to know about everything about day trading. But for now, our free course is just going to go over the basics, going to go over, touch everything you need to know. Let's get started. So, so what is day trading? Times to trade, types of day trading, and our style of day trading. So what's the difference between investing and trading? So investing, you're looking for a long-term outcome. You're putting money in and you're letting it sit. You like the company and want to invest in the company's ideas and goals, as well as how it's performing. Typically, you hold a position for a minimum of 4 months. While trading is a completely different thing. Trading, you're looking to get in and out. You're not investing in the company itself. Instead, you're reacting based on price movements, indicators, news, etc. We will be getting into that later on in this video. You can stay in a position while trading for 5 minutes to 10 days. There are multiple types of day trading. So let's just touch on the differences, the key differences. So the differences between investing and trading are this simple. So when you're investing, you're looking for a long-term outlook. You're investing in value. You're investing in the company itself. You're investing on a fundamental analysis, which is how the company is performing, the accounting behind the company. You're investing in risk management, and you also need to know a quote that I like for this is remember that Rome wasn't built in a day. So that is how you build an account slower. It takes more time, while trading is quicker returns. Trading is a short-term outlook. You're investing in price, technical analysis, which is how the chart is reacting. Volatility focus is you want to get quick jumps. You want to get in and out of stocks. Remember that Hiroshima was destroyed in a day, which means that you have to always apply risk management or you could lose your whole account value, which we'll go over risk management later on in this video. So investing. So when investing, your time frame ranges from 90 days to 12 months. When you like the company's overall performance is a reason why you would invest. This could be because it's doing the best in its sector, meaning it's beating its competitors out. You could refer to the earnings per share, meaning how the company's performing, the debt to equity, or anything on its financial statements, accounting. You could be looking to earn a dividend. While trading time frame ranges from 5 minutes to 90 days. When the stock is moving on recent news, when price action looks good, it could be going your desired direction, up or down, depending on the play that you're trying to make. When your indicators are showing a good play, when a key level of resistance is broken. We're going to touch on all of these individually. So trading news. People tend to trade on news because price reacts to the new information in a good or bad way. So if there is a good news, you could be inclined to buy because the price could be making a bullish move. For example, a company could be working on a vaccine like with COVID-19, and news on that could come out, increasing the price dramatically. So for bad news, it's the opposite. If there is bad news, you could be inclined to sell or short because the price could be making a bearish move, meaning it's going down. An example could be when Boeing's products malfunction, costing numerous lives. The price of Boeing stock after that news plummeted. So that's just a quick example on good news and bad news. Trading price action. So price action trading is buying and selling based on the movement of the price and the trail it leaves. These trails generate buy and sell signals. The trails that I'm referring to are called candlesticks. We'll touch on candlesticks later on in this session. Trading indicators. So trading using indicators is relatively simple if you don't use too many and overcomplicate it. You don't want to put too many on there because you won't understand what's going on. There'll just be lines and charts and everything, and it'll just confuse you. The idea is when a specific indicator shows a pattern that has resulted in your desired outcome in the past, you make a trade. You make a hypothesis based on the past patterns in the market. Some examples of indicators are EMAs, MACD, volume, and plenty more. We're going to touch on that later in this video as well. So trading support and resistance. Resistance is when a price goes up to a level and then it comes back down. Support is when a price goes down to that level, and then goes back up. So the best way to recognize these levels is to establish a price point that has been touched 3 or more times. So you want to see the resistance points get hit at least 3 or 4 times. You want to see the support levels get hit 3 or more times so that it establishes a clear level of resistance or support. Anything less than that wouldn't be clear. Anything more than that would be even stronger support and resistance levels. An entry could be made at the break of resistance or at the supporting level. So let me just show you a quick example. You can see here we have at least 3 times where a support level is created, right? It starts here, goes down to it, goes back up, right? Goes down to it, another time, the second time, goes back up, goes down, goes back up, goes down, goes back up. That's a clear level of support where it's supporting this level. It's supporting this level right here. The price is getting supported. It won't go under that. Or you could see resistance is the opposite, where it's going up to that and coming back down, going up to that 1, 2, 3, 4 times here, 4 times total, 5 times total, going back down. And once the resistance level is broken, new high of the day comes. The stock usually runs. That's a key level to get in at a resistance point. Break when it breaks that resistance level. So what we do here at More Than Money Trading is we combine all 4: news, price action, indicators, support and resistance levels, and apply them using something called momentum trading. So what is momentum trading? So momentum trading focuses on buying and selling according to the strength of recent price trends. As a momentum trader, you want to trade stocks that other traders are showing interest in. The more traders that show interest in the stock you're trading, the higher the price will go. So momentum trading, the more buyers, the better. How can you tell if a traders are showing interest in the stock? How could you tell? Is you just want to look for volume. You want to see buyers and sellers. That's really all it comes down to. Volume just shows how much traders are buying and selling the stock during the time frame that you're looking at. Momentum traders bet on an asset that is making a strong move in a direction to continue to move in that direction. So what it is you see the stock moving in that direction. You either get in and out of it, and you try to ride that momentum up or down. So as a momentum trader, you create a plan or an idea using past market moves. You create a hypothesis based on what happened in the past and try to predict that future. It does not always work. That's why risk management is key. Like I said before, we'll be going to risk management later on in this video. So what do we provide for our members? So day trading ideas or edges. An edge is nothing more than indication of a higher probability of one thing happening over another. So what this means is that we provide our traders with high probability setups based off news, price action, indicators, support and resistance level, momentum, as well as plenty of experience in the market. Every morning, my team and I create a plan that is put in our pre-market watch list. That's in Discord, and that's what you pay for. You get that every morning. We provide our traders with stocks to watch, as well as key price levels where an entry could be made. It is always important that you make your own decisions based on the information we provide. This is what our trade looks like here. This is what the watch list will look like in the morning. So this is something that you would see. This is an example of two stocks to watch and 2 specific prices to watch these stocks at. When you see hold here. Hold meaning you want to see a 5-minute candle close above that key level and an entry could be made. So you want to see a 5-minute candle close above that 110, right? And then when you see break, see EKSO at a break of 575. Break meaning that once you see this price level broken or it goes that above that specific price, an entry could be made. So swing trading ideas. Swing trading is when you trade with the intention to hold overnight and see what happens in the future. Sometimes you hold longer than overnight, maybe a few days, but usually trying to ride the momentum up for longer than just a day trade, for longer than just a few minutes or hours. We provide our members with a list of stocks to possibly swing overnight when we see good setups available. Investing ideas. So we provide our investors with a long list of long-term stocks that could be added to their portfolio based on the company's past and future performance. We also provide numerous other things. We provide weekly webinars, weekly webinars a help section that allows for one-on-one interaction with my team and myself, Q&As. We provide our members with all the resources necessary to become great day traders and investors. Our goal is to mold our members into successful day traders so they can work on their own. If you'd like to join our group, just DM our Instagram at daytradeguide or email us at daytradeguide@gmail.com to become a part of our group for a low fee of just $40 a month or a one-time payment of $500 for a lifetime. Okay. So before we get into how we pick stocks, I just want to go over a few basic terms to get you familiar with the lingo that we'll be saying. So bullish is the idea that the price will go up. Bearish, the idea that the price will go down. Going long, buying and holding. Shorting, selling. I'll go more into depth in that later. A ticker is the letter, group, or abbreviation that represents a company or a fund in the market. An example would be Tesla, TLSA. A few more terms to go through. So bid price is the highest price the buyer is willing to pay for an asset at that moment. An X price is the lowest price the seller is willing to sell the asset for at that moment. Dividend. A dividend is a distribution of profits by a company to its shareholders. When a company earns a profit, it can pay dividends. Not every company has dividends. Earnings per share, EPS, is just a company's profit divided by the number of outstanding shares of its common stock. The higher the earnings per share, the better. I just want to touch on candlesticks. I'll go later more in depth in this on our paid course, but this is everyone should know this. If you don't know this, look up a quick video on YouTube. But candlesticks, I just want to touch on quick because we're going to be going over them a lot. We're going to be talking about them a lot. So a green candle represents a positive or an upward trend. It moves up since the last candle. So a green candlestick is good. You can see that it opened here, right? This is the body here. This means it opened here. It touched down to this level, which is the wick. It went down to this level and went up that high and closed here. So that's the body. Those are the wicks. A red candle represents a negative or a downward move since the close of the last candle. So that means it opened at this top, it closed at the end of this body, and it had a high, whatever period this is. One day trading, we use a 5-minute candlestick period. So this would represent 5 minutes. That means that in this 5-minute period, at a high of this price, a low of this price, opened here, closed here. So how do we pick stocks? Okay. So when picking stocks, you look for setups and stocks that present a quality edge or a higher probability of them going in desired direction. So you have a higher probability of success. So how do we do that? We use a paid scanner that has custom code, which it sorts through hundreds of thousands of stocks for us. So we don't have to pick through them all because that would be unnecessary and tedious. The scanner sorts through all these stocks and leaves us with a list to go through. We then go through the list and pick stocks that meet our criteria. What are we looking for and how do we pick these stocks? So what are the criteria that needs to be met? The first is volume. We first take a look at the volume because we want to see at least 100,000 units of volume in order for us to consider a trade. We do this because we want to see that traders are showing interest in the stock, like I said earlier, before the market opens. So we're doing this pre-market. It's a pre-market scan. When we see at least 100,000 units of volume, meaning traders are buying and selling it, shows there is interest in the stock. Also, when it comes to volume, it's not just about trader interest. If a stock doesn't have much volume, when going to buy, you might not be able to purchase it at a specific price that you want because low volume, there might not be a seller at the price that you want. Vice versa. So if you're trying to sell a stock with low volume, there might not be a buyer willing to pay what you want for it, forcing you to sell it at a lot less than you expected, which will lead to a loss. So that's why we don't trade low volume for those two reasons. What else do we look for? We look for low float. Float is the amount of outstanding shares available. Low float is less than 60 to 50 million shares. What this shows us is that there is a low supply of shares available. So when there is an increase in demand, you will see large increases in price. Basic law of supply and demand, right? So low supply combined with high demand drives the price up, which is the reason why we're able to find stocks that make 100% moves, 200% moves, 50% moves, 30% moves. They only move like this because we're trading them with low float and there's low supply with increase in demand. That's why we use low float. That is very important, low float. 3, we look for gap ups. So what this is pretty simple. We look for a gap up of at least 5 to 10% from last night's close. All this means is we want to see the stock move 5 to 10% up from what it closed at yesterday. So last, we look at the price and we look at specific prices for stocks that we trade. We want to see a price between $1 and $25. Sometimes we trade stocks that are less than $1, but we try to only trade them when we see a perfect setup, because stocks that are under $1 are extremely volatile. They go up and down really quick, and you might not be able to get in and out of them. And you might take a loss quick, or they might go up quick. It's lower stocks, cheaper stocks are very volatile. Stocks that are over $25 could be good day trades, but they tend to not move as much as the cheaper stocks. So we take profits earlier with $25 stocks above. So the sweet spot is from $1 to $25. I hope I'm not going too fast for you guys. You could always play it back, make sure to take notes, etc. Okay, so next I want to go over the best times to trade as a day trader during the day, using our momentum strategy and using these indicators. So the best time to trade using our strategy are between 7 a.m. and 11 a.m. Eastern Standard Time. Obviously, it depends on where you live. I live in New York, so I'm using Eastern Standard Time. The reason for this is because we're trading looking for momentum or high levels of interest from other traders and market. And the market sees most of its action between these hours, 7 a.m. to 11 a.m. Eastern Standard Time. Also, there is something called Power Hour, which is from 3 to 4 p.m. This is another good time to day trade because the market comes back to life at this hour. The best time to trade are these times with the highest level of volume, which occur between the 7 a.m. to 11 to 3 p.m. to 5 p.m. Eastern Standard Time. Obviously applies to where you live. So next I want to go over what trading software to use and what broker I recommend for our traders. So the best broker to use is TD Ameritrade. With my experience, I realized that TD Ameritrade is the best. I've sorted through either Webull or TD Ameritrade. Robinhood is no good. TD Ameritrade I recommend using. And there's numerous reasons why, and I'm going to go through them all. First, they offer Thinkorswim, which is a trading software that has the best chart setups and execution styles. You're going to see Thinkorswim later. I'm going to go into that later and show you how to set up some charts. It also is relatively simple to navigate when you get the hang of it. Thinkorswim. The second reason why TD is the best is because it allows for unlimited day trades as long as you're using a cash account. I recommend using a cash account always because it allows you to trade equity. It allows you to only trade the equity that you have. If you have a margin account, which is the opposite of a cash account, or the other, if you either have a margin account or a cash account. So if you have a margin account, you can trade borrowed money, which can be dangerous as a beginner. So make sure to have a cash account for those two reasons, especially when first starting off. Once you get more experience, if you want to have a margin account, you can. But I recommend when you're first starting off, between your first year, second year, you want to have a cash account because you never want to overstep your boundaries. You never want to go into debt, especially when trading stocks like this. So third, TD Ameritrade has no commissions. So TD Ameritrade doesn't charge any commissions, which is very helpful for traders just starting out with small accounts. You don't have to worry about commissions outweighing your profits. Also, don't trade over-the-counter stocks, which is OTC. That's what that means, because you will be charged commissions. So when you'll be able to see when it says OTC, it'll say what platform it's going through. You'll see OTC. So you never really want to trade OTC because you would charge commission. I personally never trade OTC stocks because they're very risky and they aren't regulated by the SEC, which is they aren't regulated by the SEC, which is the Security Exchange Commission. Had trouble saying that with that right there. So no commissions, great, key. So next we have pre-market trading. So TD allows for trading to start at 7 a.m. Eastern Standard Time, of course, which allows you to get a jump on the market compared to Robinhood, which only allows you to start trading at 9 a.m. the earliest, which is that could affect your trading, right? If you want to sell, if the stock moves or stock's at a specific price that you want to get in, and by the time it opens, you might not want to get in, or you might not want to be might not be able to sell at the price that you want. So, in order to get executed pre-market when using Thinkorswim, you have to go to your active trader and need to change your TIF. See here, you change your TIF on your active trader from day to extended, and then once you place an order, it'll be executed pre-market. So the last is after-hour trading, right? So TD allows you to trade after hours as well until 7 p.m. Eastern Standard Time. I'm not going to say Eastern Standard Time anymore. I hope you get the picture that I'm from Eastern Standard Time. That's the time that applies to me. Whatever applies to you, minus California, minus 3 hours, and so on. So TD allows you to trade after hours until 7 p.m., giving you an extra 3 hours after closing. The same PM setup applies to after hours. So your order must have an EXT instead of where TIF is. If you want to place an order, you want it to be executed after hours, you must change the day to extended, and that will execute your trades. That's how you'd be filled pre-market and after hours. Okay, so here we get into the meat. So indicators and how to set them up. Indicators, trader's best friend, right? So what is an indicator? An indicator is a signal or a sequence used by a trader when he or she is making a technical analysis of a stock and its chart. A technical analysis is just making a decision or coming up with an idea just looking at the chart, not looking at the company's background, which is a fundamental analysis. An indicator shows a trader what might happen in the future based on referring to what happened in the past. So indicators don't always work. They just help you find a better edge or hypothesis. Indicators help map out their traders' trades and build a plan. Every morning you want to build a plan, write down a plan. You never want to use too many indicators, like I said earlier, because it can overwhelm you and make you overanalyze everything. So what indicators do we use and what indicators do we recommend you using? So there's a few. We recommend using volume, like we said before, news, which is like we said earlier as well, relative strength index, RSI, exponential moving average, EMA, volume weighted average, VWAP, and moving average convergence / divergence, which is MACD. I'm going to refer to them as their abbreviations to make it simpler, and so I don't have to have mouth garbage coming out of my mouth like that again. So let's start off with volume. So volume of a stock shows the activity of other traders based on the period of time that you're using. So like I said, we use 5-minute periods, right? So each one of these candlesticks is 5 minutes. Each one represents a 5-minute period. So when a stock is showing volume, it means there's a lot of buyers and sellers. The more volume, the better, which depends on what your trade idea is. If you want to sell, right? Volume is shown in the pre-market scanner as well as the line chart. So I just want to show you here. You see these blue lines on the bottom? This is what volume is. So you can see as volume increases, the price increases, right? The price follows as it goes up, which so an increase in volume tends to be a relatively good sign, meaning buyers are increasing. News. So another indicator we use is news. News for a company can affect the price of a stock in a good way or a bad way, like we said earlier. Good news on a company could be an indicator to buy, like for example, the COVID news, right? Bad news for a company could be an indicator to sell, for example, is the Boeing news, right? So those are just a few examples. So catalysts are very important. So a catalyst is news or an event that pushes the price of a stock dramatically up or down. A catalyst could be anything, like an earnings report, a new product announcement, a piece of legislation, a lawsuit, an offer to buy a company out, and even an outbreak of war. Catalysts are very important when day trading. A lot of the stocks we trade move on catalysts. They move on these ideas because people see this happening, so they start buying it up, and momentum starts to increase and more people know about the stock, then momentum starts to increase, and the price goes up and up. And that's how Catalyst is where we make a lot of money through. Great indicator news. So the next indicator that we use, and I'm going to go over, is RSI. So RSI is a technical indicator that charts current and historical strength or weaknesses of a stock based on the closing prices of the most recent period. So I know that sounds confusing because it is confusing. So in simpler terms, RSI shows if a stock is oversold, meaning it's undervalued, or overbought, meaning it's overvalued. So here's what the RSI chart looks like, right? This is what it looks like here. It would go under your chart. So there's two horizontal lines on an RSI signal. So if the value is showing above the upper line, then the stock is currently overbought and oversold. Let me go back to this. So if it's showing above the upper line, it is currently overbought and overvalued. Sorry, overbought and overvalued, not oversold. So if the value is showing below the line, the stock is currently oversold and undervalued, right? So overbought up here, overvalued, meaning the price is too high and you should not pay for it if it's this high, and undervalued, which means it's oversold, which could be a good price to get in, right? Good price to sell, good price to get in. Okay, so when the RSI value is above the upper line, like it is here for Tesla, it is therefore overbought and overvalued and can be used as an indicator to sell, right? So you can see here how it corresponds to the chart. So once it's above our top horizontal line, it is clearly it's overvalued and it starts to drop. So if you're holding it, a good time to sell it would be once it goes above this top RSI level, right? So let's go to the next slide. So for a buy signal, when the RSI value is below the bottom line, it's oversold and undervalued, and it could be used as an indicator to buy. So as you can see here, this is another Tesla chart. I just don't have the name. When it goes below the lower RSI, it is undervalued and oversold, which could be a signal to buy the stock, right? And you shows here a clear example that it would be a great trade because you get in here and look at it just runs. It runs from there. RSIs are great. RSIs work best though for longer time frames. So it works best for like swing trade ideas, long-term investing. It also works for day trading. Don't get me wrong, it works for day trading, but I've seen it work best with my experience for longer time frames, meaning 4-hour candlesticks, where each one of these candlesticks represents a 4-hour period instead of a 5-minute period. Okay, the next indicator. Excuse me. EMA. An EMA is a moving average of price reactions based on the period. This technical indicator comes up as a line on your price chart. I'll show you that in a minute. It can be used to create buy or sell signals based on crossovers and changes in historical prices. So the more experience with EMAs, the better. So as you trade more and more, you'll be able to notice how EMAs are reacting to specific stocks, and you'll be able to make trades based off that. So different levels of EMAs are used for different investing and trading styles and time frames. So the longer the outlook, the higher the time frame you want to use. So for investing, the long-term outlook, right? You want to use a higher EMA. So you could use a 200-day EMA because the longer time frame and the outlook used, right? So a cross above the 200-day EMA could be used as an indicator to buy and hold for the long term, right? And a break below could be used as a signal to sell or liquidate the long-term position. So I'm going to go over that quick again, just in case you missed that. Also, you can rewind the video, of course, but it's very important. EMAs are very important. They're one of the most used indicators as traders and investors. I use it personally a lot. So a cross above the 200-day EMA could be used as an indicator to buy and hold for the long term, and a break below could be used as a signal to sell or liquidate your long-term position. So for example, here we have Tesla, right? The green line on our chart is a 200-day moving average. When it breaks below it, it's a clear signal to sell, and look how it drops, right? Look how it drops. You would sell around here since it broke below our 200-day, and once it breaks above it again, gone. It's gone. It's that simple. Break below, sell. Break above, buy. And just look at that. From 550, Tesla obviously is crazy stock, but this happened. This is not just for Tesla. This is for every stock, most stocks. You can see this is just a crazy example where you made 100% on your, you made 100% return on this trade. So you could see at around 550, the 550 level, 600 crosses above the 200-day moving average, does not come back down near it again. Doesn't come back down near it. Bounces off, you know what I'm saying? Doesn't come back down near it. Doesn't even threaten to break that line, and goes up to 1,032, where you would make it nearly 100% on your investment. So you could see here when looking at Tesla, this is a 4-hour time frame, right? These are 4-hour periods. Each one of these candlesticks represents a 4-hour period instead of a 5-minute period that we use when day trading. So day trade time frames. Day traders use shorter time frames instead of 200-day moving averages. Use smaller time frames. So smaller periods and moving averages could be used when day trading. So when day trading, we use a 9-day moving average and a 20-day moving average, EMA, a 20-day EMA, 9-day EMA and a 20-day EMA. The same overall concept when creating signals to these time frames is applied to short-term time frames, right? The longer time frame, shorter time frame is just different periods, different time frames with the same ideas. So a price below the 9-day moving average could be an indicator to sell or not buy the stock. So see this yellow line here. Once it breaks below our 5-minute candlestick periods, right? 5-minute periods would be an indicator to sell or not buy the stock or not get in. So it's vice versa. So just how the 200-day moving averages, this works the same way as the 9-day moving average, just a shorter time frame. So a price riding above the 9 EMA could be a signal to buy or not sell the stock. So you can see here, this is a great move, a great example, going from 1250 and not breaking through it until 16, right? Not going through, that's nearly what, 30% quick, just on using this one indicator. So the yellow line shows our 9-day moving average, breaks above it, and goes to the moon, right? That's why EMAs are my favorite. And there's another thing that you could use with EMAs. So you can combine 2 separate EMAs on shorter time frames. So you can combine 2 separate EMAs that could create buy and sell signals, clear buy and sell signals. We use a combination personally of, everyone is different. We personally here at More Than Money Trading and Investing, we use a 9-day EMA as well as a 20-day EMA. When these two moving averages, these lines, right, cross, it is a signal to either buy or to sell based on which crossover, right? Which crosses over which. So when using a 5-minute time frame and the 9-day EMA, our yellow line here crosses above our 20-day EMA, our green line here, it indicates a bullish move, which could be used as a signal to buy. So you can see here right on this chart, right as these cross, look at that cross, the 9 yellow crosses above the 20 green, and doesn't even come back down to cross it below it again, and you could just ride that all the way up for a nice return. So just like the crossing below for the 209, this is vice versa as well. So this works in the same way, but just opposite, meaning that if the 9-day EMA, our yellow line, crosses below the 20-day EMA, it is a bearish move, indicating a indicator to sell or a signal to sell or not buy the stock. So once we see our 9, right, our yellow cross below our green, our 20, it's an indicator to sell or to not buy. Next, we have VWAP, or volume weighted average price. We're going to refer to it as VWAP like we've done before, just to be simpler. So VWAP is a indicator that gives the average price of the stock that has been traded throughout the day based on the volume and the price. So VWAP is another line on your price chart, just like EMA is. It has a lot to do with institutional investors, so we're not going to go into depth with this. I'm just going to explain how it works simply for day traders like us. So to keep it simple, a stock holding above the VWAP could be used as an indicator to buy, and vice versa. If the price is below the VWAP, it could be used as an indicator to sell or to not make an entry at all. So let me just show you here. So VWAP is our purple line here, right? So once it breaks above and holds above, it's an indicator to buy, and once it breaks below, it could be indicator to sell. So here, as a day trader, you're not trying to get, you're trying to make some short-term moves, and this is a great short-term move from 1.7, to around 2.2, 2.4. That's a good move. That's a great trade as a day trader. That's all you want. That's all you need as a day trader. What do we have next? MACD. MACD is a great indicator to use. So MACD is an indicator that reveals changes in the strength, direction, momentum, and duration of a trend in a stock price. So MACD is its own separate chart that looks like this, right? This would go below this. It wouldn't be able to see how these are lines. MACD is not a line. It is its own separate chart, which would go below this chart. You would see it somewhere down here. So MACD with the combination of other indicators could be used as a signal to buy or sell based on the chart's position. A signal to buy could be when the lower MACD line, which is blue, crosses above the upper white line. It shows the start of a bullish trend. This works in both ways, right? So the blue line, right, this is a clear one where it's closer to the center, right? When it breaks above, showing a bullish trend, and then vice versa. So when it breaks below, it's showing a bearish trend. And look how it works here. Look how it works here, right? You get in here, right? Ride that up to here. Goes below, sell, goes in. And it doesn't work all the time, but you can see how it clearly works here. So this works both ways, like I was saying before. A signal to sell could be when the blue line crosses above, indicating the start of a bearish move. So look, breaks above, bullish move, buy signal. Breaks below, bearish move, sell signal. Breaks above, buy signal. Breaks below, sell signal. Like it's pretty much that simple. You don't want to overcomplicate things with indicators. You want to keep it simple. You want to keep it light. You don't want to have too much things going on, because then you'll get confused. You'll overanalyze everything, and you won't be able to make decisions. You won't ever be able to execute trades. Okay. How do you set up indicators on Thinkorswim? I'm going to show you quick. I'm going to go into my own Thinkorswim page quick, and I'm going to show you how to set up these specific indicators that we just went over. How to set up. Give me a second to pull it up. Okay, so right here we have Tesla on a 5-minute period. So we're going to start off with news. It's very simple. This is your chart. News. Live news pops up right away. There it is, right here. So you see the right side, live news. That's simple. Okay, now we're going to go into RSI. Edit studies I'm going to go to. I'm going to go to this box up here, and I'm just going to simply type in RSI. We don't want to get it into these RSI crossover to complicate things. That's more experience. So I'm going to click RSI, right? Add selected. Click OK. And there we go. There's our RSI. Look, above, below, right? Here's our RSI. I'm going to exit out of that. Apply. Okay, and next we have EMA. Let's look it up. So it comes up as move av exponential. That's what EMA is. That's what it comes up as. So what we're going to do is we're going to click add selected. And I'm going to add 2, right? Because we want the 9 and the 20. So automatically, you can see here, comes up as a 9-day moving average. 9-day moving average, right? So what we're going to do is we're going to go in and we're going to adjust the time frame. So instead of the 9 on one of them, we're going to change it to 20. you could change the color, anything you want down here. You know, you can make it, let's make it white for 20. And let's make the 9. Let's make it red. Okay. Yeah, they are. Man, the red's not too good. Let me change that quick. Can't clear it. You can't see it that clear. Purple. Boom. There it is. Look. So you see our 9, purple, break above our 20, bullish move, bullish move, bullish move. You see our 9, break below our 20, our white line, bullish move, bullish move. I mean, bearish move, I'm sorry. Bullish move right here, breaks 9, purple, breaks above our white line, line, which is our 20. So our 9 breaks above our 20, bullish move. Our 20 breaks, our 9 breaks below our 20, bullish move, right? So 9 breaking above our 20, bearish. I keep messing that up. I don't know why. So 9 breaks above our 20 EMA, our white line, purple above white. That is a bullish move. Our 9, our purple, breaks below our white, our 20 is a bearish move, a signal to sell. Signal to buy, 9 above 20. Signal to sell, 9 below 20. Sorry about that. A little confusion. So what do we have? What else do we have? Volume, weighted average, right? VWAP. What we're going to do is click on VWAP, add selected. We're going to go to settings. And what we're going to do is we're going to go to upper band. And we're going to uncheck this because we don't need these. And we're going to go to lower band. We're going to uncheck them because we don't need them. Right? All we need is the VWAP. So it's going to come up as purple. Click apply. And you have your VWAP. Breaks below, look, breaks below, clear sell signal. Breaks above, clear buy signal. What else do we have? MACD. I'll leave that on there. Add selected. Apply. Okay. Now you see how, remember like I referred to it before that it goes, it's its own chart, it goes below. Look, so the blue line breaks above our white line, bullish trend, buy signal, breaks below, sell signal. So that's going to wrap it up on our indicators and how to go over them and how to set them up. If you have any questions on how to set them up more, don't hesitate to DM me at DayTradeGuide on Instagram or send me an email at daytradeguide@gmail.com. Okay, now that we're done going over indicators and how to set them up on Thinkorswim, I want to go over where to start as a beginner. So I want to go over how much capital to use and how much you should start with and where you should practice, right? So before you even start trading with real money, you should start with something called paper trading, which is offered on Thinkorswim. Paper trading is just a trading account that you trade with fake money. Is an option that can be picked when signing into your Thinkorswim account, which is the image that we have here. So instead of clicking on live trading, which would make this green, so that thing would be to the left, this to the right, which allows you to paper trade, and you go into account and you trade exactly how you would on your live account, but you trade with fake money. So paper trading allows you to test your ideas. It allows you to trade plans without costing you anything. It allows you to help get acquainted with the software. So it allows you to get acquainted with buying and selling, using Active Trader, you clicking, buying in and out, so that when you do start trading with real money, you know what's going on. You don't make any mistakes and it doesn't cost you anything. It also helps you get acquainted with the software too. Like I said, it shows you, it allows you to get practice on how to get in and out, and going over the charts. So personally, when I first started trading a few years back, I used with paper trading. I highly recommend starting with paper trading for at least a month or 2 months max. Anything more than 2 months would be wasting time, because when paper trading, you're missing the most important thing as a trader. The most important part of trading, which is emotion, as well as order placement. Because when you're paper trading, you're not trading against anyone. You're not trading against market makers. Your orders are getting placed right away. You're not having any problem executing. So that's a problem with paper trading. That's why you don't want to do it too long, because you want to start building emotional capital. You want to start getting your emotions in check. And I'm going to go into emotions a little bit later. So after you're done paper trading, right, 1 to 2 months, or whenever you feel comfortable in getting into using real money, it doesn't have to be a month. It could be a week, it could be 2 weeks. Whenever you feel comfortable in trading with real money, um, you're going to need to start with some money, some sort of capital, some sort of dollar value, right? I recommend starting with at least 1,000 and a maximum of 5,000. Anywhere in between is great, but you don't want to trade with anything less than 1,000. You don't want to really trade with. You could, right? You could trade with more, but I think when you're first starting, this is the good numbers. These are great numbers to start with. So risk management. So talking about how much money to start with leads us right into the topic of risk management, right? So when placing trades, our profit target here at More Than Money Trading is a 2-to-1 ratio. This means that we will risk 5% of our equity in that trade in order to get 10% return. It is very important to set stop losses to protect your capital. So when we make an entry, we always set a 5% stop loss to minimize losses. So when you're trading pre-market or after hours, you're not allowed to use a stop loss. So we use something called a mental stop loss, where we come up with a specific price that if it goes below, we will automatically sell. This allows us to hold on to our capital and not lose too much per trade. Also, we do something called scaling. Scaling. Scaling means that we sell 1/3 or 1/2 of our position at a 10% gain. So once it hits our 10% target, right, our profit target, I usually sell 1/3 or 50% of my shares, depending on how the chart is presenting itself, right? It depends how the chart is presenting itself. So everything is different. Every trade is different. So, but I usually sell 1/3 to 1/2 of my position. Sometimes I don't sell any of it if I hit my 10% target, because I could see that reacting on the price and how the chart is presenting itself, it's going to keep going. So this strategy allows you to capitalize on your gains, right? It allows you to minimize your losses and maximize your winners. So not every trade will be a winner. You're going to lose money. You need to understand that as a trader, you're going to lose money. There's no way the best traders in the world don't make money every trade. It's not possible. That's what it's about. That's what trading is. You cannot expect to make money every trade. You will take losses, and that's why it's key for risk management. That's why risk management is key, because you need to minimize those losses. If you follow our 2-to-1 ratio, you only need 33% of your trades out of 100 to be winners, right? So that means you need 3 to 4 trades to be winners. So you need to get 10% on 3 to 4 trades, and the rest out of 10, right? Three, you get 10%. The other 6 or 7, you lose 5%. As long as you keep that strategy in your mind and use that strategy, you will make money. You will be a consistently successful day trader. So that's a 2-to-1 ratio. So risk. You also only want to risk 1 to 2% of your total equity in each trade. This means if you have a total amount of dollars in your account as 10,000, then you should only be purchasing 1,000 worth of stocks, right? Let's see what else we got. So that means that shares you want to only purchase. So you have a $10,000 total account equity, right? That means you only want to purchase $1,000 worth of stock, right? So say it's at $10 and you're only going to buy 1,000, you're only going to buy 100, right? So you only want to risk 5% of that. So 5% of your total $1,000 is $50, which is only 5.5%. It's less than your 1 to 2%, right? So when you make a trade with $1,000, you're only risking $50, which is only 0.5% of your total 10,000, right? So if you take a look at this Excel doc that we have on our next slide, you can see that, for example, we have a $5,000 account here, account total. You would enter your trade with 10% of your account, right? 10%, which is $500. And you would shoot for a profit target of at least $50, risking only $25, right? So say the price is $4 per share, you would be able to buy with your 500, 125 shares. So your 2-to-1 ratio will be $50, 10% gain, stop loss at 25, right? And then this goes up, right? So you can go to 3-to-1, like I said before, maybe scale some at 2-to-1 and let this ride, or scale some at 3-to-1, let it keep going, or your 4-to-1, 5-to-1. But you can see here, the sweet spot is the 1-to-2 ratio, where your win accuracy to break even is only at 33%. That means only 33% of your trades have to be winners. That's not that hard to do, as long as you're following your plan and executing your trades. So I know $50 on a doesn't seem like that much money, right? It's because it's not that much money, but using this strategy and protecting your capital in this way will allow you to build your account slowly. It is not a get rich quick scheme. Everyone needs to understand that. You need to get that through your head. Trading is not a get rich quick scheme. It is a marathon. It is not a sprint. I know that's corny, but it's true. You must use proper risk management in order to protect your capital every day, every single morning, no matter what. So if you guys want to get this Excel doc, just send me a DM or an email, and I will happily send this to you. So you could plug in your account total, and then you could plug in the price of the stock, and you can go from there. 33%, 1-to-2, right? So next, we're going to touch on mindset. So one of the most important aspects of trading, it is the most important aspects about trading, not putting indicators and everything to the side. Mindset is number one. So the most important aspects of trading is having a proper mindset. You need to understand, like I said before, it is not easy to trade, and it is not a get rich quick scheme. You need to have the right attitude, or you will let the market beat you down. Always be willing to accept everything for what it is, and be open to learn from all your experiences and your mistakes. Personally, I am still learning from every experience that I'm making. I'm learning every day, and I'm learning more and more every day. And a year from now, I'll be learning more. And 2 years from now, I'll be learning more. And 3 years from now, you never stop learning when trading. And you need to get that through your head. You need to always understand that every day is a learning. It's a learning process. Every day, it's a learning process. Learn more and more, apply it. Learn more and more, apply it. Learn from your mistakes. Try not to make those same mistakes again. Apply what you learned from yesterday to today, and you will be a consistently successful day trader. You must always learn from your mistakes. Figure out what you did wrong. Figure out why you did that wrong, and improve on those mistakes one step at a time, and try to not make the same mistakes again. You're going to make the same mistakes again. You know what I'm saying? It's going to happen. But you need to make sure you write down what you're doing wrong and put into your head that this is what I did wrong. This is why I did this wrong. And I am not going to do this again. Accept mistakes and learn from them, right? So follow a set of rules. You should follow a written set of rules so that your strategy stays consistent. So I personally have a set of rules that it ranges between 1 and 20 set of, like, it's 10 to 20, right? 10 to 20 rules that I read every morning before I start trading, and it goes into everything. So I follow that no matter what. DM me if you want to know about my specific set of rules. I will send you a few. I'll show you how to set up rules. I personally built my set of rules after years of experience. I would add a rule, I would learn, and I would add a rule, and I would learn about what's going on. And maybe a few days later, I would add another rule, so that when I was able to get consistent with it, where I was following these rules every day. Okay, so goals. So you must set realistic goals for yourself. When I talk about goals, I'm not saying let me make $1,000 a week. Let me make, you know what I'm saying, $100 a day. That's not what you want as goals. That's not what you want to do. It's not that you want to make $1,000 a week, because that will make you force trades. You know, that will make you force trades that aren't there, because you're like, oh, I'm at 750 right now, and I'm at 750 right now, and my goal is to make 1,000 this week, and it's the end of Friday, so I'm going to go out and I'm going to look for a trade to make me $250. No, that's no good, because that's forcing trades. You end up losing money because you're not trading great setups. So you want to create healthy goals that aren't things like expecting profit, right? You want to set healthy goals that are like, I'm going to track my trades every day. I'm going to learn and be consistent with my trading. I'm going to create a plan. I'm going to execute that plan, and I'm going to get better every day. That's what you want to do. You want to talk about how I'm going to make good trades today, win or loss, like profit or no profit. A good trade could be a loss because you followed your plan and you execute that plan. So set realistic goals. Don't set profit target goals. Emotions. Get this out of there. Sorry about that. Emotions. Okay. So emotions are a huge part of the mindset of trading. Once you start trading with real money, after you get away from, I don't know if you already have some experience or you're going to start trading on paper trading, but once you start trading with real money, emotions will come into play no matter what. Because you're trading with money, there's money on the table. For this reason, it is important to have a proper set of rules to follow so that you can follow your rules and not your emotions. Don't let them make decisions for you. Do not let your emotions make you leave a trade early. Do not let them make you get into a trade, right? Because, for example, FOMO is a huge thing with trading and day trading. Like you see a stock going up and you're like, oh, I don't want it to miss. I don't want to miss it. Keep going up. I don't want it to miss. Keep going up. So let me buy here, which is that's your emotions. That's your emotions saying get in because you don't want to miss out. That's your emotions. That is not a plan. That is not a good strategy. So you chasing that stock, right? Oh, I'm going to get in here. It went from 5 to 10. Now it's at the 10. I don't want them to miss it going from 10 to 20. So you get in at a 10 and drives back down to 5. And then that's not your plan. That's emotions making you enter a trade. You never want that. FOMO is no good. FOMO is no good. FOMO is no good. I cannot say it enough. FOMO is no good. Do not trade FOMO ever. So do not let emotions like that make them make a decision for you, right? Do not make them allow you to trade. Like, don't make FOMO force you into a trade because that's no good. This will take a long time to be able to conquer and get over, right? But as long as you're consistent with it, week after week, day after day, and work at it, you will get better. You cannot stop your emotions, right? You can never stop them 100%, but you can stop them from controlling you, and that's the key to trading. Stop emotions from controlling you. You're human. You're not a computer. You're gonna have emotions, but you can allow them to be there and not control you. So patience is also key when trading. You also need to be patient. It is your job as a trader to sit in your chair and wait for opportunities. So be patient, wait, don't force trades. Let the trades come to you. If you don't see a good setup, don't trade that day. There's nothing wrong with not trading one day. Like just because you don't see a trade, just because you didn't like every day does not mean you have to trade every day. You don't have to trade if there's no good setups and you're not comfortable with taking trades. Sit it out. Don't worry about it. There's no reason to trade. If someone else is making a trade, who cares? Don't worry about them. Worry about yourself. That's all that matters. 5 truths to eliminate emotional pain, right? So there are 5 truths that I read in a book that will help you eliminate emotional pain. The first is to understand that anything can happen. Anything can happen in the market. The market is unpredictable. You never know what's going to happen, ever. You're never going to know what's going to happen. So first, understand that anything can happen in the market. Second, next, you need to know what's going to happen. Excuse me. The next is you don't need to know what's going to happen in order to make money, right? Don't try to predict the future 100%. If an edge comes up, execute it, and then act accordingly as the future presents itself. Don't worry about what's going to happen. Just execute, act accordingly as it comes. Execute, act accordingly as it comes, right? Say it goes up 10%, scale your position. That's acting accordingly. Say it goes down 5%, sell your position. That's acting accordingly. Act accordingly as the trade comes. The third is that there's a random set of distribution between wins and losses for any given set of variables that define an edge, right? So that means that it's a probabilities game. Don't worry about it. You take a loss. It's the cost of doing business. Think about it as someone paying for advertising. It's a cost of doing business, right? It makes me available for that next winning trade. It sets you up. You want to stay in that moment and flow. Taking a loss makes you available for those winning trades. It allows you to get those big winning 100% trades because, right, you take a loss on a 5% here, you take a loss on a 5% here, and then you keep executing, right? You keep following that plan, and then sooner or later, right, there's going to be a 100% gainer, and you're not even going to remember that 5% loss because you're going to be up 90%. That's why you need to keep playing. Like, what did they say? You hang out in a barber shop long enough, you sooner or later you're going to get your hair cut. Same idea. Corny, but it's true. Fourth is that an edge is nothing more than an indication of a higher probability of one thing happening over another. So like I said, here at Momentum Trading, here when we're doing momentum trading and at More Than Money Trading and Investing, we create an edge for you. We get that edge, we put that in our pre-market watch list for you. We find those stocks and we find those edges. We find higher probabilities of it going in one direction than the other. It's not always going to work, right? The probability doesn't always work. That's why you have risk management. That's why you have 5% stop loss. And last is that you must always remember that every moment in the market is unique. Every moment is unique. This stock will not have the same reaction as another stock yesterday. Can happen again, but it's not going to be exactly the same. It'll never be exactly the same. Never, ever. So what we do here at More Than Money Trading is we make a pre-market watch list every morning, right? And we show you specific prices to buy a stock at. You must make your own decisions, right? We're not saying get in here. We're not saying you must use your own discretion and make your own decisions and if you want to buy and sell a stock. We're giving you this information on a plate, which stocks to buy, what price to pay for them. We're not giving you on when to get out, but this information, let alone what stocks to buy when day trading, swing trading, or investing is way, way worth more than $40 a month. Let alone, $40 a month is nothing compared to like we had today is June 24th. We had our member, one of our first members ever traded. He made his first trade. We walked him through his first trade. He got into a stock at $7 and he swung it, which means he held it overnight. He woke up and the stock was at $12. It was at $12 because he executed that trade. He wasn't afraid to make that execution. He followed our plan and he made about $500 on that one trade in one day. And for the cost of joining our watch list was $40. It cost him, he doesn't even care about that anymore because he paid for it tenfold just on that one trade in one day, 2-day period. So on our crash course for day trading, we're going to wrap it up with that. We hope you guys learned from this video. Don't hesitate to join our group to get the stock picks and help you out every step of the way with your day trading career. We have a decent amount of members right now, and we're never closing. We're not going to cap it, so don't worry about that. We're always happy to take new members in. We always answer questions. We take you to that next level. We make you the best trader you could be. That's why we're here. That's why I'm here. I love making people financially free. That's what it's about. So don't be afraid to join our group. DM me at Day Trade Guide and come make money with us. Thanks for watching the video, guys. Hope to hear from you soon. Thanks a lot. Bye, guys.